interest rates. Anyone else sick of talking about them? How about credit scores? The Consumer Financial Protection Bureau? I've got all the sexy topics for you guys today. Even medical collections. Oh, and mortgage bonds are so in the red right now, they're actually on fire. It's Jobs Report Friday. Not my favorite, but you can't really avoid them. They come every month. We've been pretty tense all this week watching the 10-year treasury yields because this has a direct correlation to mortgage interest rates. When the 10-year is up, mortgage interest rates deteriorate, and the inverse is also true. Yields on the 10-year have been bumping up all week against a ceiling of resistance at 4.375%. And this was making us really nervous because if they broke through here, there wasn't much to stop them before they hit 5% on the 10-year. And the last time they hit 5% was when interest rates were at their highest level of my 12-year career. So what happened this morning? Pretty much worst case scenario. The jobs report that we expected to come in showing 160,000 jobs added came in showing 256,000 jobs added. We were looking for an unemployment rate around 4.2%. It came in even better at 4.1%. So we saw a sell-off in bonds and interest rates are deteriorating as I speak. Of course, we should have expected some seasonal jobs from the holiday season, but 100,000? And there wasn't much in negative revisions for previous months either. It was, all in all, a pretty strong report supporting a persevering economy. I wonder to whom we should give credit for that. I myself have talked a lot about an inflationary president taking office this month. But a strong economy, very specifically a healthy labor market, is a major component as to why we're seeing interest rates remain elevated. Depending on your politics, you could really find an argument to blame or give credit to either of the options we had. But the data and reports have consistently shown a resilient, dare I say it, strong economy. Yes, even after a change election that was rooted and people wanting to take back this shitty economy, it turns out it just simply wasn't. The facts have continued to show, wait, sorry. I know, facts don't exist anymore. But the data and reports have continued to show an economy that was strong enough to withhold under an aggressive rate hiking scheme from the Fed. And I'm saying this to you guys as someone who was watching this all happening, thinking there was no way the labor market was going to persevere through all this. So my politics aside, this has been interesting to see. I digress. The 10-year did jump above 4.375%, and you now know what that means for mortgage interest rates. So we will remain in a market where you can do temporary and permanent rate buy downs and where there are opportunities for those whose skin is thick enough that they stick around and can actually spot them. In other news, the CFPB is not messing around in 2025. That's the Consumer Financial Protection Bureau, and we got a lot of news from them this week. I posted some content, and we'll start with the good. Medical collections no longer report to the credit bureaus at all. This spurred a lot of conversations when I posted a reel about it. I understand that many medical providers will be impacted if people don't pay their medical bills. And the mess we are in is certainly not the fault of doctors out there or even therapists. You may or may not know this, but I started my internship this week to be a marriage and family therapist. Those mental health providers also bill under medical. The only recourse that medical debt collectors have had to get you to pay your bill is that it will impact your credit score if you don't. But should they be able to weaponize your credit score against you? This is something that impacts so much of your life, not just from your ability to get pre-approved for a loan, but your ability to finance a car, start a business, open some kind of accounts. We know what a mess medical billing is and the situation with the insurance companies. It's a system that's broken. So maybe it's for the best that it won't impact your credit score anymore when these errors happen. I can't solve today's health crisis in today's blog, so I'm just going to be the messenger today. Medical collections will no longer impact your credit score. Buy now, pay later programs, though. These are something to watch. I posted a reel about it because I think there's a financial crisis looming right here. Not alone, but coupled with the fact that Americans are under the pressure of a crippling amount of credit card debt. If we back up to my rant earlier, just a few minutes ago, maybe we never had an economic problem. Maybe Americans have a behavioral problem with spending. Once their credit cards got maxed out, it looks like they turned to buy now, pay later programs like Klarna, Affirm, and Afterpay. They spent about $18 billion using these programs just over the holiday season. The CFPB now has eyes on this industry and has promised increased regulation for non-bank personal type loans. And so I think it's something that we should watch because we've all been wondering for a long time how the American consumer continues to spend and spend despite whatever they feel about this shitty economy, leading to sticky inflation. Save the dates, guys. If you're a realtor here in Reno, RSVPs will soon open for Mortgage and Mimosas, and it's going to be pretty cool. I can't talk about what it is just yet, but it's one that you're going to want to save a spot for, and there are only 50 spots in the room. Futurist Female is also coming up on Thursday, March 6th here in Reno, and you can actually grab a ticket now or even sponsor a table for all of your besties. Even the ones not in real estate are going to want to attend this time.